Insurance. Have it even if you don't need it. Because sometimes in life, you might need insurance. And what I'm talking about is whole life insurance and including it as a part of your portfolio, your financial portfolio, if you will. And it will not allow your family to fall through the cracks financially in case something happened to you and or if something happened to them, to your family members. And so I think it's very important to have insurance. I'll share a little story with you. Again, the name is Paul Lawrence Van, and I'm sharing this about whole life insurance primarily because the way my story goes is that when my mother passed away, I was not even aware that she had a policy on me. And she did. And we found a copy of it. And she left me some money and some of my other siblings some money. But unbeknownst to me, I just decided that, if mom did this for me, then I have to do the same thing. And so I'm going to be talking about whole life insurance today and why you need it. And I know a lot of people have term policies, but when it comes to whole life, it's a whole different dynamic. And that's what I'm going to share with you today as I continue on my pursuit of helping people to better understand the financials and how they can help themselves. That's what it's all about. So, when considering whole life insurance policies, there are several key factors to keep in mind, especially regarding its role in estate planning. Knock, knock. Estate planning is not going to be the end all, be all, the end all, but it will be a addition, a contribution to what you're trying to achieve overall with your financial portfolio. And it also have an impact both on you as the policyholder and your family members. And in keeping with what I've been doing over the last several episodes, I have my one slide, and here it is. So I'll keep this up here for a little while so that you can observe it and kind of take in what it's saying, and I'll go through. So let's look at some key considerations for whole life insurance. And permanent coverage is unlike term insurance because whole life insurance provides coverage for the policyholder's entire life as long as the premiums are paid. You have to pay your premiums, people. And you already know that, but it's something that you want to have. And I know when I was in the military, we had a policy out there, and it came to, at the time I was in, it was at maybe 300,000, but now it's gone up, if I'm not mistaken, to 450,000. So in case something happens, then the family would be covered for that amount, or whoever the beneficiary is going to be. I was single the entire time doing the military, so it would have went to my parents if they were still living, and my siblings. So that's kind of how it is. And whole life insurance ensures the beneficiaries receive a death benefit regardless of when the policyholder passes away. Whereas with term life, just as a comparison, it only pays on death, but whole life is a whole different dimension in which you can consider, and that's why I really recommend that you at least give it some consideration. Here's another reason why: the cash value accumulation. So in other words, let's say if you put in, let's say $100 a month, so you have $1,200 a year, and that amount would draw interest in a cash accumulation, whereas with a term policy, it's only based on how much of the policy that you get. So if you get a $100,000 policy, that's all you get. But with a whole life, and let's say if you got a policy for $1 million, then it would pay out $1 million in the case of death. So it's really a remarkable instrument, which a lot of people should consider. So it builds cash value over time, which can be assessed through loans or withdrawals. So if you deposit some money in there, how much ever you have, you can get a loan against it. For example, if you have $20,000 and you wanted to make a down payment on a house, or if you want to pay off some student loans or purchase a car, then you can take that out. You don't have to go to a bank for it. So in essence, you become your own bank, or what people call infinite banking. And you don't even have to include the middleman, which happens to be the lender, the bank. and you'll get more preferable rates coming out of your own insurance policy. You'll have to pay that money back in, but the aspect is that you've accrued and built up cash value over time, so it gives you more leverage. So the cash value grows at a guaranteed rate, providing a financial resource that can be tapped into for emergencies, education costs, or retirement planning. So that rate may be 4%, it may be 5%, depending on who the particular insurance company you go through. And then you want to look at the premiums. So whole life typically has higher premiums than term life insurance. And prospective policyholders should consider their budget and whether they are commit to the higher costs over the long term. So if you get a policy and you pay on that policy for 10 years, 20 years, 30 years, you're going to accrue a lot of dividends and premiums. And dividends, many whole life policies are eligible for dividends, which can be reinvested to purchase additional coverage on your policy. So now I'm going to take down the slide for a while so you can see me a little bit more. And again, you have premiums, you have dividends that are playing a role. And so it's totally different than when we look at a term policy. And so you also want to look at from a estate planning benefits. So whole life can play a crucial role in estate planning by providing liquidity to cover estate taxes and other expenses, ensuring that the heirs receive their inheritance without financial burden. And it can also be used to equalize inheritance among heirs. So in other words, money that comes from an insurance policy is not the same as money that will come from, let's say, a bank account. So a bank account, you're going to be taxed on it, but from an insurance policy, you will not be taxed on the monies. And that's another really great benefit because it's tax-free. So here are some examples of some benefits. Financial security for dependents. For a policyholder with young children, as an example, a whole life ensures that the family will receive a significant payout in the event of any untimely death. And so it can also cover daily living expenses, education costs, and help maintain the family's standard of living. And then there's a wealth transfer in there. For example, an individual with a growing estate may use whole life as a tool for wealth transfer upon their passing. The death benefit can help heirs pay estate taxes, prevent the need to liquidate. And this can be particularly important for families with real estate or have business. So it's one of those things whereby it has a lot of benefits. The benefits outweigh the positives outweigh the negatives when it comes to having a whole life policy. And so for retirement planning purposes, whole life can be a component of a comprehensive retirement strategy. So let's say, for example, if you retire from the military, and then if you had a whole life insurance policy, you can draw money from your whole life policy in addition to your retirement benefits or disability benefits or any other source that you may have, 401k, etc. But remember, on the 401k, you're going to be taxed on it, but from the insurance, you will not be. And so that's very important to understand. And then you can build legacy. For example, some individuals purchase whole life with the intent of leaving a financial legacy. For example, a grandparent may take out a policy to ensure that their grandchildren have funds for college, for fostering educational opportunities that might not otherwise be available. So as an example, the grandparent could very well just decide, hey, I'm going to put this policy together and ensure that my grandchildren to get their education without any reservations. And so to help you understand this, investing in a whole life policy is not just about securing a death benefit. It's much more than that. It's really about providing long-term financial security, building cash value, and facilitating effective estate planning. And so by carefully considering the implications and benefits of each policy, individuals can make informed decisions that positively impact their families for generations to come. And I just think that insurance is a very important aspect. To give you just another example of just how powerful insurance is, especially a whole life policy, many CEOs and presidents of companies, instead of taking a salary, they request an insurance policy, a whole life insurance policy, because they know that it will grow, and over time, that if they leave the company, they can still build on it. And so that's why it's very important to have that insurance company. And I'll put it here again. You see the nice family here, and the parents are securing the future of their children in the event that something happens. And we know in life, all things happen. And as I tell people, it's better to have insurance than not to have it. Have insurance and not need it than to need it and not have it. That's really what it's all about. So I would really highly recommend that you consider getting a whole life policy. Listen to me. I'm not paid by any insurance company. I'm not telling you which one to go to. Some insurance agents don't even understand a whole life policy, one that's more of a legacy type, where you can, if you passed away with your policy, it will be left to your beneficiary and they can continue that policy on and on. And then when they have children, their children can continue it. So it's a very good idea and one which I highly recommend that you give consideration to. So the other thing that I wanted to talk about and I wanted to share with you is, for example, I mentioned it earlier. I'm not going to go into it a lot, but using a whole life policy as a means of becoming one's own bank is a strategy often referred to as infinity banking, which I mentioned earlier, or banking on yourself. This approach leverages the cash value of a whole life policy to provide liquidity. And again, it's tax-free. Whenever you take it out, it's tax-free. So it gives you flexibility and potential investment opportunities. So you can take money out. Let's say if you want to invest in condos or a REIT, a real estate investment trust, then you can take out a certain amount of money and invest in that and grow on that. So you can actually build from the investment portion that you take out. Let's say if you have 30,000 in there, you want to take 30% out, that's 10,000. And you want to invest it in REITs, which is apartments, or you could invest it on grocery stores and things such as that. And you can actually gain even more through taking money out of your own account. And you didn't even have to get the money from the bank. You're actually getting it from yourself because you become the banker. And again, it has the cash value accumulation. So whole life insurance policy accumulate cash value over time at a guaranteed rate. It depends on which insurance company you go through. And remember, some insurance companies don't write legacy type insurance policies. So you have to do some research and find out who does. And then you want to access the cash value. So policyholders can borrow against the cash value of the whole life policy. And so again, you won't need a bank if you needed to get money, if you need to put a deposit down on a house, or if you wanted to get a new vehicle, you can get it from your policy, and you can just avoid and not even have to be concerned with a bank because you're your own bank. And then the loan terms against the policy, cash values have lower interest rates than a bank would anyway. So it's important to note that the policyholder, you must pay the interest on the loan, and any unpaid loans will reduce the death penalty if not repaid. And then there's more repayment flexibility. For example, if you looked at a home purchase, a policyholder can accumulate cash value in their whole life policy over several years. And when they want to buy a home, instead of taking out a traditional mortgage, they can borrow against the policy's cash value. Or you can get educational funding or investment opportunities I mentioned before, or emergency funds. We all know that emergencies happen all the time. And it also can supplement the retirement. So some of the things I want you to consider is that the interest cost while borrowing against cash value can be advantageous. Policyholders must consider the interest on the loan and ensure that they have a plan for repayment. You're basically just paying yourself back. That's basically it. And then what's the impact on the death benefit? If the loan is not repaid, the death benefit will be reduced by the amount of the loan plus any accrued interest. So if you had a $100,000 loan, you took out $10,000, didn't pay it back, the policy would just be worth $90,000. But you're still in for the good. And then one of the things to consider, and here in conclusion, is using a whole life policy as a banking tool can provide significant financial benefits when managed correctly. The strategy offers flexibility and control over one's financing, allowing policyholders to access funds for various purposes while potentially building wealth over time. And I believe that this is a really outstanding opportunity. And at this time, my time is up, and I thank you for yours. Again, this episode is all about whole life insurance and why it's important to have it. I'll see you on the next episode. Have a great day, everybody, and thank you very much. Good day.